Please, a warm welcome to Gaurav Dubey. Thank you.
Okay. Um, Ladies and gentlemen, thank you so much for actually coming back. If I was at your place, I would be busy networking outside. I'm assuming that you have a little bit of interest in what the future of finance and digital assets is. And if not, then you're afraid of Yuri like me, and so you've stepped in. Everybody's afraid of Yuri and his horrendous jokes. Um, I'm Gaurav Dubey. I've been investing for about 15 plus years in early stage equity, sometimes private equity, and then got into crypto in 2015. I've built a hedge fund, I've built a VC, and a whole bunch of companies in mining. Currently, I'm folding all of my businesses that are dedicated to different sides of a startup from early stage to later stage into something called a digital asset treasury. It's a NASDAQ publicly traded company, of course. That's what they do in NASDAQ. And what it essentially does is it allows access to crypto portfolio and crypto value, if you find value in crypto, of course, through equity and general equity instruments. So we'll quickly run through the history of capital markets. I'm not going to, blow your mind with insane amount of data that you already know and whatever. But basically, a beautiful timeline of financial instruments, and actually the most successful financial instruments in this case. 1993, S&P 500 was launched, and I'm sure everybody in the room knows what S&P 500 is. For those who don't know, I'll give you a philosophical purview of it. S&P 500 is often called the bedrock of finance, because if you are an institution in any shape or form, the biggest holding most of the time or the safest holdings are S&P 500. It's also the parking capital venue for a lot of institutions. And so the CAGR, the annual return for the last whatever years, has been 8.3%. It recently outperformed, not going to get there. 2004, 11 years later, we discovered gold ETFs, and we all know what gold ETF is. And the CAGR is 9.9%. Again, recently went to 11-ish and then came down. These numbers are about a few months old, by the way, I'm sorry. All of this was essentially a good and easy way for people to have access to assets that are, let's say, slightly complicated to custody, right? You can access financial instruments easily through equity and equity instruments, and you can have access to, a whole basket of equity through S&P 500, like the top 500, and gold through gold ETF. And then the first innovation, I would say, and again, I'm biased, the first real innovation happened in finance almost 16 years later, when a guy called Michael Saylor started buying bitcoins on his books, on his book of accounts, and his company equity sort of represented the value of these bitcoins. Of course, a bit of value of his business, but the business was dead, essentially. So let's not even talk about it. And MicroStrategy, up until a couple of months ago, has produced, since 2021, a CAGR of 53%. I think that's insane for anyone who understands institutional CAGRs. And 4 years later, we already have, Bitcoin ETFs. By the way, by volume, holdings, and AUM, Bitcoin ETFs have beaten every single ETF of the past, including gold, including the 24-hour volume, 7-day volume, 30-day volume, and I think now getting to a year. The CAGR is 77%, actually much better now. So what's next? How do we, what does this roadmap sort of ascertain or hints towards? We created equities, and we created S&P 500, and the world made S&P 500 the bedrock of finance. It does more value and volume than all the equities combined, of course. And so now we have a whole bunch of crypto. And I think 90% of the people in the room still have a problem taking custody of crypto, understanding what is what, and of course, a lot of that is bullshit. And then what is actually real value, and so many more details. I mean, the biggest problem is custody still. Like, a lot of institutions still don't understand the custody part of crypto. And so the clear hint on that timeline is that somebody has to make a basket of performing crypto, more like a Berkshire Hathaway model of crypto, put it into an equity instrument, most likely a public equity instrument, and make it available for practically everybody around the world. And so that's what we are promoting. We call them DAT 2.0, micro-strategy, where you're simply buying assets, one asset, Bitcoin, the asset of value, is now evolving into DAT 2.0, where what you're doing is you're acquiring more valuable assets. But let's not forget, crypto is not just value. Crypto is programmable value. And that's the killer app of crypto. And so the DAT 1.0 is only capitalizing on the value side of crypto, while DAT 2.0 will capitalize on the programmable value, hence called DeFi of crypto. Well, this actually works. I mean, it's big, but it works for the first time. I'm sorry, actually, for those who find the presentation too institutional, I was presenting it at ADGM a couple of weeks ago. So I can actually just leave a whole bunch of pages. Cool. I'm just repeat this. For institutions and masses to access digital assets, they need a public, compliant, auditable instrument, which is equity, public equity, that delivers crypto's growth, dividends from DeFi. We can get to that of what DeFi is. Through a regulated equity without the complexity of crypto, such as custody, volatility, accounting, and valuations. Simple, easy line. What are we looking at in terms of DAT 2.0? I need a time check somewhere, because I can speak on this topic for 2 years. OK, Yuri is in front, of course. You can be assured that I'll have a bottle on my head if I go anywhere around 6 minutes. So how many of you know DeFi, by the way? Or you think you know DeFi? Incredible. What am I talking? OK, guys, then I can finish in 1 minute. We take DeFi yields. We have a history of 6 years producing DeFi returns in my hedge fund and the market maker. We are bringing these returns into the Treasury. So we acquire Treasury from the stock value, of course. We deploy this Treasury into DeFi liquidity pools. We take those yields, but instead of simply buying more crypto, we are giving this out as dividends. And hence, we are the world's first fixed income product that is enabled through DeFi. And again, I'm not going to quote numbers here, but the performance so far has been 11 to 19%, which is almost insane for a fixed income products. And I met a bunch of you yesterday in the VNTR Clubhouse opening, and almost the smallest investors in the room, like people, not smallest, but they do small checks, they are holding products that are fixed income in their portfolio, because everybody likes, free inflow of capital every month. We can do it quarterly, though. I think I'm quickly going to just run you through the diversified exposure versus crypto holding chart. I mean, a few images that can give you an idea of why a well-diversified portfolio is so much better than holding one asset. At this point, I would always, like to conclude with a very beautiful story for me and people in finance. When Berkshire Hathaway invested in Eastern Railways and Coca-Cola, I mean, basically Eastern Railways, everybody thought it'll be the biggest company of all times because rail will run the world, right? And then they invested in Coca-Cola. And of course, there can be nothing bigger than Coca-Cola because it was the first company that would hit every single home in every single refrigerator. And then came Yahoo. So of course, now it is the biggest company and biggest possibility of the future ever. And everybody jumped onto Yahoo because, internet is the future. Google, Apple, Tesla, NVIDIA. So people every decade or period of time will keep falling for a particular investment as a cult. But the investments have always evolved, and they will keep evolving as per this pace of innovation. And so S&P 500 has been always the most incredible shape of settled and stable returns and investment. And so in crypto also, the rule wouldn't be changed. Like Peter Schiff says, in the capital markets, you're wrong the moment you say it's different this time. So it's not different this time. It's going to be the same. We are assembling a whole bunch of assets, putting it into a public equity company, giving you exposure to mature growth of assets while also giving you access to quarterly yields as a fixed income product. Thank you so much. I'll be around to take your questions. Do I have time to take questions? The cameraman wants a question. I know I was fast. Any questions at all? Oh, the name of the company. I'm so sorry. Well, because it's a public company, we cannot announce the name of the ticker as yet. We have acquired the NASDAQ company, but for now we referred it to as crypto strategy. So MicroStrategy, but for crypto.
And what sort of assets are you going to have in your portfolio?
Incredible question. We have distributed it, that is the tagline. The asset acquisition side is based on our metrics. Of course, it's a public company, so the metrics will be public. But we're putting a 60-40 ratio to companies above $10 billion market cap and companies below $10 billion market cap. So anything above 10 billion market cap will be acquired and, of course, deployed into the ecosystems, the DeFi ecosystems of the market, of the rest of the 40% portfolio.
When you say companies, is it tokens or protocols, or is it like real companies?
All of these are real things. Vitaly, you sound like an outsider. You're a crypto guy. Okay, let me answer it. I was joking, of course. We need a fair bunch of infra as well as utility companies, because we both have been investing for 10 years. We both know that the future is pretty diversified, so we can't stick to just one sort of investments. So we have certain amount of, like, let's say, a fair portion of infrastructure tokens on both sides, but we also want to go into utilities. Just to maybe entice you a bit, we are investing in companies that are enabling MasterCard DeFi pools. Like, MasterCard DeFi pool was never available to average hedge funds. Just about 12 hedge funds have access to that. There are huge invoice discounting companies in Egypt, Pakistan, Saudi Arabia that do about 500 million in quarterly invoice discounting, producing about 40% returns. How can you have access to that? So basically, we are able to get all of that yield and access that is crypto-enabled but not crypto-dependent to everybody. You have a question? Incredible question. Is there a trophy? Can I give it to him? So I would encourage you to go back and check the DeFi returns and DeFi performances of the last 5 years, where we have seen the bottommost of crypto market, right? And you'll be surprised that DeFi returns haven't actually dipped below 20%. So the killer app of crypto today, well identified, is DeFi. Right? And it is actually non-crypto enabled. It is it's non-crypto dependent. It's crypto enabled by all ways and means. So if you would talk about some crazy pools that produce 80-90%, we all know that it's unsustainable. But if you go back to the more sustained pool with billions of TVL, they range anywhere between 7% to 15%. And that has been consistent for the last 15 years, and the DeFi has only grown 20 times since then. Make sense? No? We'll sit statistically.
Talk one-on-one.
Thank you so much, guys. You've been an amazing audience.